What's going on, guys? Brian's here. Today is Friday, November 8th, 2024. The market is currently open, so excuse me if I'm talking pretty quickly, as I have a lot I would love to cover and I have some positions that I would actively like to manage. This is my risk profile on the E-mini futures. So this is the ES. I'm in a broken wing butterfly that is 0 DTE. This is the P&L on this position right here. We're going to cover this position. We'll take a look at why a trader might consider running a position like that. This is the SPY on the left-hand side here, and this is the SPX. As we can see, the market just hit 6,000 for the first time, so we have a new all-time high. We'll take a look at a swing trade on a different type of broken wing butterfly on the SPX. This is from yesterday into today. We'll take a look at the same ES broken wing butterfly, that's 0 DTE on option strat, if it makes it a little bit easier for you to understand this user interface, or if you're not a thinkorswim user. Just a quick update on the broken wing butterfly that I swung from earlier in the week. You guys might recognize this from a video that came out a couple days ago. And then lastly, in the quant trading app Discord, some of the gamma exposure from earlier today, as well as the quant trading app proprietary trade engine. So some of the data targeting 6,000, as this was a key reason as to why I was targeting the 6,000 strike. Let's start first with the swing trade from yesterday. This was just before the market closed, so everything is in Eastern time here. So 3 minutes before the market's close. You can actually trade index and some ETF options 15 minutes after the market closes if you're under PDT and you're looking for a swing trade into the next day. Now, I mentioned this is a cheap 1 DTE shot at the SPY hitting 600. So this is the same spread opened right here. It's now hitting over 200% return on the debit, not the max loss. This is the margin requirement for a trade like this. And this is how much you are actually debited to open a trade. So it's showing it's up over 250% because it is up over 250% from the debit. However, if you're actually calculating your return on margin, you would want to use the actual collateral or the actual margin requirement here. With option strat, you don't need to do the math. You can actually just switch this over here to the percentage of risk. You can pull it down to the actual current time, and then you can hover over it here, and you can see that it's actually up about 24% of the margin right there. Let's start first with why 60-20 on the SPX, and that will come from looking at the charts. This is the SPY on the left-hand side here, so let's maximize this. And you guys will know from previous videos that I say the SPY is the main instrument in which I use to analyze the S&P 500. But I'm showing you guys examples of how I trade the ES options as well as the SPX options. We'll even take a look at the XSP later in this video. Yesterday, as the market was going to close, all I did was just click right here, which is pretty much where the SPY was at the time. But let's just say we go down to here, and then I dragged my mouse up until I hit about 600, and then right here in this box that you guys can see is hovering around my mouse, it's calculating that for me. So as I drag my mouse up here and I come to 600, I don't have to move the mouse all the way over here. You can just go straight up this way and let it line up with about 600. I saw that the market would have to be up about 0.75%. So all I did was come over to the SPX, and then let's zoom in, stretch this out, and see right here. So if I clicked, let's just say the SPX was right around here at that point. Let's make sure we're using this tool here. You can actually click this from down here. That's the same tool, or you can use the shorthand. If you're using a mouse, you middle click on your mouse, and then that brings up the tool menu. I'm clicking this here, and then I'm clicking this, and then I drag this right up until the percent pretty much matches what I saw in the SPX. And that brought me to around 60-16, 60-15 or so on the SPX. So with a calculation like that, what I'm going to consider is if the SPY was to go to 600, that should put the SPX in this area right here. So I want to target a butterfly right in this area. However, because the market is pretty extended, we are at all-time highs. At that point in time, the market would have been up over 4.25% for the week, which is already an outlier of a week. But we had a catalyst. It was the US general elections. We are at all-time highs, so there is no real previous resistance. The market is in price discovery mode, which means it can keep trending up for the next few months if it wants to. There's no reason for it really to pull back. Understanding this and understanding momentum is why my bias is going to remain to the upside until the market proves this is no longer the direction in which you want to be trading. That might come in the way of breaking a previous day's low and then closing below it. So let's just say on Monday the market was to close below today's open, or it was to close below the previous day's low. That would show a break in trend and a break in momentum. But for now, for the most part, it looks like the edge is looking to buy dips or buying pullbacks to something like VWAP or any type of EMA or whatever method in which you use. I like broken wing butterflies because they are extremely flexible. They are an advanced trading strategy, but once you get used to them, you realize they're not that difficult. I'm essentially targeting 60-20 because I just added an extra 5 points just to give it a little bit of buffer in case the market was to go way past in which I was expecting. But there wasn't enough reason to think that we would go up to 600 and then blow past it when there was only 1 day left in the week, and there wasn't really a major catalyst on the schedule for today, as well as understanding the market was already well overextended for the week. The risk, in my opinion, for the market being up another 1.5% or so for the day was very low, so that's why I decided to run a broken wing butterfly strategy, and I made sure that the debit to this side was not expensive. In other words, if I was wrong and the market gapped down or it just sold off or it was flat overnight, there wasn't really much risk associated with the trade. In order for the market to have gotten past this strike, it means the SPY would have had to blown past 600, which in this case, or my experience, is a very unlikely scenario. But when you trade these types of strategies, you don't need to sit there and just hope. There is something you can do, and that's when I like to look at something really cheap as maybe some sort of insurance or hedge, and that's where the XSP comes into play. So I grabbed an XSP call, which is the 602 strike, which is the equivalent of 6,020 on the SPX. But this time I decided to go with November 11th expiration, which is Monday, just to give it a little bit more time so it's not as susceptible to time decay. Anyone that trades options know if you buy an option and you hold it and it is very limited DTE, time decay is going to eat away at that option. And when this was purchased, it was Thursday, which was yesterday, and it expires on Monday. That's not a lot of time for an option like this. If the market was to pull back, the price of this option was only 58 cents, so it was only $58 to buy just one lot here. This one lot, in a sense, would be protection if the market was to go up a full percent or more. You guys can see right here. Well, this is from the current timestamp, so this is not actually what it would have looked like from yesterday. But if the market was to go up 1% from here, this position would be up over $400. There's a little over 2 hours left in the trading session here for today. So let's just say the market miraculously was to pop another 1% at most. This position would be down 1,000, while the XSP call would be up almost $500. And that's already a reduction of risk of around 40 to 50% from the broken wing butterfly. So that's something to keep in mind as a little tip here. If you're running these types of butterflies and you are concerned that, hey, what happens if you're right on the direction, but you're concerned that the market might go even further, maybe use something that is a lot cheaper of an option and just buy it with a little bit more DTE and consider that your hedge or some sort of protection. But I was never really that concerned about this particular trade here. I'm actually out of the trade, so there isn't really any other concerns here. So this is sharing it. This was for anyone with a smaller account just on the XSP. Similar situation, 62 is the same as 60-20 on the SPX. In this case here, this trade costs less than $20. The max loss is less than $120. And the same thing, this trade right now would be up almost 300%. I closed my trade out earlier today as it was just about 100% return. So once I hit about 100%, I was perfectly content with the swing trade. The reason why I closed that out is because at that point in time, this is 11 a.m. Eastern time, so a few hours from now, I didn't really see much activity higher than this strike price here. If I'm targeting something that's higher, in other words, I'm targeting this area with a butterfly, I want there to be enough activity in that area also. I'm going to read this as the market is going to stall out around here, and I don't really like it for a 0 DTE play, because even though it was a swing trade yesterday, today it is a 0 DTE trade, and the markets, in my opinion, would consolidate around here, and that would drive me nuts. So as we take a look at price action, we can see how choppy the market has been over the past few hours. And for a 0 DTE trade like that, no one knows if the market is going to break over 6,000 to actually get up to this area. And there's not that much time left in the day. So I just followed one of my main rules. Whenever I'm up on a trade that's up at least 100% and it's a 0 DTE, instead of giving back all of that profit, I'd rather just lock in that position. Now for a 0 DTE trade, that's where I decided to open up a separate position here on the ES. So this is also it right here. It's just one lot, as you guys can see. I'm targeting 60.35. Why 60.35? I'm doing the same thing I usually do. If we pull up the ES on this chart right here, I just clicked this and I said, hey, if the SPX goes to 6,000, where will the ES be? And that was about this level right here. So I put this level on my chart. Then I told myself, if we went a little bit higher and we landed around this area, where will that butterfly land? And that's pretty much how I loosely chose my strike price of 60.35. As we can see, that's just where the ES is just about hitting and getting rejected. So that means earlier on today, I don't remember when I actually opened up the trade. Let's see if we pull up here. So just around 25 minutes or so after the market opened is when I opened the trade. I mocked this up in the option strat, again, just because it's easier for beginners to actually interpret this. This is how much the trade costs. In this case here, there's no risk to the upside because I didn't know how far momentum might carry the market in case I was wrong and the market did blow past that level. I didn't want the same level of risk with the swing trade. So in this case here, the swing trade had a decent amount of risk to the upside. The XSP call was protection for 50 something dollars if we kept going up. As you guys can see, this position is only up $13.53, but this is not really a position in which I'm monitoring or paying attention to. I just pulled up the risk profile actually just to make this video to show you guys how cheap the XXP options can be. So this is the live position here, and I've made sure to turn off any other conflicting strike prices. As you guys can see, I closed out any other 0 DTE positions or any other swing trades here just so we can focus in on this particular butterfly. I layer sometimes 6 to 10 different positions on the S&P 500. So I might have maybe 2 to 3 positions running on the SPX. I might have 2 to 3 positions running on the ES. I might have 1 position running on the SPY, and then maybe I'll grab another position on the XSP. And that's why it's difficult to simulate or copy and paste exactly what another trader is doing. A video like this, I'm just trying to share an overall arcing idea, and hopefully it can spark some sort of inspiration regarding how you can approach your own trading. This is more so in alignment with risk management and portfolio management, in my opinion, than it is actually trading. I'm just using the tools and using the data that's accessible to me, and then I'm coming up with some sort of an opinion, some sort of a target. There's enough signs pointing to the direction and understanding the overall momentum and understanding sentiment, and then I'm just managing the risk accordingly by placing money in different places that's going to give me the best opportunity to make a return on that investment with minimizing risk as best as possible. If the market went down overnight, I would not have been worried about the $92 plus the $50 on the XSP. It's about $150 or so in max risk. That means if the market gaps down 3%, there wouldn't have been a concern. The reason why I left this up here is, you guys, this is the trade that was swung from earlier in the week. Now I'm out of this trade and I've realized the position as well as the position that was on the NQ that, again, that was mentioned in a couple previous videos ago. But if the market did gap down about 3% today, there was the opportunity for a massive return on the ES as well as the NQ. So I was actually looking for some sort of a pullback overnight on these positions. These would have been up a couple $1,000s, where I would have been down about $150 on these ES and SPX positions, which would have been of little to no concern. This is the main position here for me today, which I'm actually going to realize pretty soon, as I won't be at my desk for power hour today, and I don't want to leave an ES option to let it cash settle after the market closes, as strange things tend to happen. I'm much more comfortable letting SPX or XSP options expire after the market closes, but I don't have the same confidence in futures options after the market closes, and I wouldn't recommend leaving it up to your broker to settle your ES options. Let's take a look at the SPX data here and the trade engine from Quant Trading app. And let's just scroll to a little bit earlier in the day. So let's just go all the way to this morning here. And this is yesterday. So right about here is where the market would have opened today. So this is 9:45 Eastern time. We have the power strike, which is a proprietary calculation for Quant Trading app, and it is in alignment with the absolute gamma strike. So that's why we see this dashed level here that's purple, as well as this orange golden level here. And it is also the strike price that has the highest amount of positive gamma. So the P1 strike, as we know, in an overall net positive gamma environment, tend to act as a magnet. Price likes to drift towards these high positive gamma nodes when we are in an overall net positive gamma environment, especially when there is bullish momentum in the market. So P1 is already a magnet in this case. The absolute gamma strike is going to act as a magnet more times than not. And then our proprietary QTA strike is also in alignment with 6,000. So at the start of the day today, it became an easy, almost a no-brainer concept to think, hey, the market's probably going to head towards 6,000 today, possibly even Monday, but I'm more interested in just the 0 DTE to round out the week. Do I want to put some sort of risk on 6,000? This is a summarization of the data already telling me that. The 0 DTE gamma exposure is also confirming this. If we pull this up here, this would have been 21 minutes after the market opened. This is our absolute gamma strike. We can see also how much call volume is going into this. That's what the blue level is in the background here. We can see this spike or this peak. We can see that it is a pretty dominant net positive gamma strike. We also see that there's a decent amount of net positive gamma higher than that, which is something I also highlight in these gamma exposure videos. It's always good to see another strike price that is higher than the one you are targeting that also has a decent amount of gamma. So if you are a bull and you're targeting to the upside, you want to see some activity higher. If this strike had a lot of net positive gamma exposure also, this 25 strike here, that would have given me a massive confidence to believe the market was definitely going to go to 6,000 and possibly push higher for today. If it held over this level, I would have definitely had more confidence in seeing the SPX head up to 60.25, similar to the videos in which I've released previously on gamma exposure. Because that's not what the data is showing us in this particular case, you want to be a little bit more conservative regarding your target. So if the SPX is at 5,985, then conservatively a decent target is 6,000 to 6,005 based on what this gamma exposure profile is showing us. In my experience, you don't want to target much higher than that. Doesn't mean the market won't go much higher than that, but it's entering uncharted territory, and this is where you're more in alignment with gambling or hoping it goes higher versus having enough information or data to back your thesis up. Regarding supports, as I'm looking at this profile, it's right here at 5,980. This is the strike price that has the last decent level of positive gamma. It's also the strike, as we see in the background here, has a spike in put volume as well as a spike in call volume. So a decent amount of things lining up at 980. I would tell myself if the markets can remain above this strike price here, then this becomes our zone or our targets for the day. Anything higher is a bonus if you're holding calls. But because we're at all-time highs and there's no previous resistance, there's always the risk that the markets might go higher or further than you expect. And that's why I would structure a butterfly like this. As conservative as it might be, I'm going a little bit further than where I think it's going to go by targeting 60.35 on the ES, but I'm eliminating any risk to the upside once I closed out the other SPX butterfly. And then at the same end, there is this XSP call that has no risk to the upside. So these strategies are just layered on top of each other and just stacked, and they're all creating a profile around risk management. And I'm just loosely following what the data is telling me. I'm not trying to predict. I'm just going right along with the information. And if we scroll towards present time now, we can see the same thing. We have these couple of towers right here at 6,605. Still not that much of a reason to think we're going to go much higher. However, we've seen during power hour, the market just puts in this random spike, 10 points up or 10 points down. That's pretty common over the past 4 or 5 years or so. That's pretty common over the past 4 years to just see a random move the last 10 minutes of the day, 10 points in any direction. But because I don't see enough data to support that, I'm not going to target it. If we take a look at this here, we see that our power strike is still at 6,000. We are now coming up at the 1 sigma close. According to this data here, 60.30 is still within reasonable range, as that's only the 1 sigma range for today. So it is still possible, but there isn't much other data to support that. The same thing would have to clear this strike price here, which is essentially what I'm targeting, which is that 60.15 area as mentioned as early as yesterday. We come back to this option spreads here and let's scroll up. That's where initially this was the target. This was our cheap shot at 60.20. I'm no longer in the trade, so obviously it would have been nice to still be in it, but I'm just following my rules. There's an opportunity here for a massive lotto winner for a trade that only costs $92 in terms of a debit to make over $1,000. That's a 10x return on a trade like this, which is excellent. And even from a margin requirement, that's 100% return, but I doubt it's actually going to pin or close around there. I'm just leaving it up so I can track it when I come back home to see where it actually ended up closing. This is the trade I'm currently in. This is the trade that was the swing trade that was realized already here. Around $440 is what was locked in. While this video might have been a little bit all over the place, I figured I'll just share something to close out the week to showcase some thoughts that I have, why I open certain positions, how I'm managing certain positions, how I layer multiple positions on top of each other, how I'm managing my risk. If you enjoyed this video as a little bit of an insight regarding how I might manage one account or one type of portfolio, let me know in the comments down below. Share this video if you learned something, like it if you learned something. Thanks for watching, guys. And by the way, all these trades and all these strategies which I've shared can be done with an account below PDT. And this style of trading can be done with an account around $5,000 to $10,000. So it doesn't actually require that much capital, relatively speaking, of course, as long as you have margin account and as long as you're approved to trade options and you're approved to trade futures options, there's so much flexibility. And PDT is actually something that doesn't have to hold you back. As you guys noticed, the SPX options were open yesterday and they were swing into today. The XSP option was a swing trade, also opened yesterday. The ES options were a swing, but then the 0DTE ES option is 0DTE. And again, futures options do not follow the same PDT rules. You can day trade them as much as you'd like. And that's the beauty, in my opinion, of being a trader or being an options trader in general. There's so much flexibility. There's so much creativity here. Look at the structure of this butterfly. Look at the structure of this butterfly. Look at the structure of this butterfly. They're all three completely different types of broken wing butterflies. These two are pretty similar to each other regarding no risk to the upside, but this one doesn't really stand to make much if the market went much higher, but it was a 0 DTE. Because this was initially opened last week before the general elections, there was no way to know how far the market would have went, so I didn't want any risk to the upside, but I wanted there to be an opportunity to make a decent return if the market did go much higher. And then the same thing like this with the 1 DTE trade, there is an immense amount of risk associated with this. So why not grab a really cheap XSP out the money call for if the market blows past this strike price, there is protection regardless of how high it went, even though there was no data to support we're going past 60.35 to today. Anyway, I'm going to cut the video here before I just keep going around in circles. I hope there was value in this. This type of video is fun for me because this is a direct reflection on exactly how I trade. I had not seen anything like this when I first started trading, especially options. I thought you just buy a call, you buy a put. I had no idea you could mix and match and, layer so much things, and you can think about things more on a situational basis. It fits my personality so much better. It might be complicated for another trader. For me, this is relatively simple. It's actually fun. It makes it a little bit more exciting for me as a trader because compared to scalpers, this style of trading is relatively boring. You open the trade and you wait hours, so it keeps it a little bit interesting to me. And the key ingredient is being able to understand your risk profile, knowing how to use this, knowing how to measure different scenarios, and ultimately not confusing yourself by having too many different positions open. Thanks for watching, guys. I'll catch you on the next one.